Good morning, everyone. Welcome to this update for the 2nd of July. The rotation in the US stock market from technology, which has been the leader for quite a long period of time, certainly for all of this year, continues. It's all pretty mild, but definitely the correction in the tech sector is not finished yet. And we are seeing that continued rotation into particularly financials, but also biotech and some parts of the industrial sector as well. So let's have a look at the action from last week. And just to summarize what I'm going to be covering in this update, I want to have a look at how the tech sector is looking, because that's obviously of great interest, and the money that's coming out of the tech sector, where is it going? What's happening with commodities, and let's get on and look at American stocks. US S&P 500 was down 15 points for the week, and we saw that the technology sell-off is not over. We've now gone down and formed another little low, but it's all pretty mild action. The volumes are very modest, and the daily ranges are not large, and they're not closing near their lows either. So there's plenty of evidence that buyers are coming in towards the end of the session. And that money is going into financials and biotechs. There is a little bit of contraction in market breadth. So in other words, the number of stocks setting new highs is lessening. And so that bears watching. But look, it's still at a very high level, and it's not come off dramatically. I expect to see continued gains on global indices. We've seen the German DAX, the FTSE, basically continuing to hold near all-time highs and certainly multi-year highs. And economically, Europe continues to improve. Consumer sentiment is improving quite significantly in Germany in particular. So some very positive signs coming out of Europe. The other point I want to make is that the gains that we've seen in the US stock market are coming from earnings growth. They're not coming from expansion of the PE multiples. So in other words, the PE ratio is moving up from 17 and a half, where they've been for some time, and moving up towards the 20 mark. That's not what's happening. We're seeing some good old-fashioned earnings growth, and that's what you want to see the stock market underpinned by. Why people continually trot out the Shiller-Cape PE ratio and point to the fact that it's 29 and it's at ridiculous highs, and therefore the market has to crash. I think these people are just looking selectively for evidence that suits their case, which is they want the bear market to, or they want the bull market to fail and roll over into a bear market for whatever reason. But history shows that the Shiller-Cape ratio is nearly always high, irrespective of what's going on. And the reason for that is that it's a backward-looking index. And this is the thing that really confuses me. The stock market, I mean, everybody knows that the stock market is a forward-looking pricing mechanism. The stock market is pricing in where they think the earnings of companies and the value will be in 6 to 12 months' time, not what is happening today. So therefore, why would you look at a PE ratio that was looking backwards over 10 years? It just makes absolutely no sense to me. That's just, a crazy way to look at it. And the fact that the Cape ratio is always high because it is backward looking, I don't think justifies anything much at all. So I really don't get it at all. And I suggest that you ignore those articles that are focusing on that way of valuing the stock market. But putting all that aside, in any case, stock markets don't top out because of valuations. Stock markets top out because everybody's got their money in, and money starts flowing to a more attractive area. So it comes out of equities and may go into bonds or some other asset class. Stock markets don't top out just because the valuation is high. So that's a complete misunderstanding of how stock markets actually move. So let's take a look at the US index. So this is the S&P. Let me just tighten in there a little bit. So you can see that it did come off mildly. Had a bit of a wobble on Thursday, but you can see there was certainly buyers came into the market. We went down and touched the blue 50-day moving average line and bounced. And then we had an inside day on Friday where the market finished down a little bit. It did close on its lows, but the range is very small. And as I said earlier, the volumes are quite modest. So there's really nothing to be concerned about there at the overall index level. And while money is coming out of the tech sector, it is not coming out of the market. It's been rotating into other areas, biotech and financials specifically. So let's just look at the tech sector. So there's the XLK, which is the technology index, and that looks very much like the Nasdaq. Now you can see it's mildly below the 50-day moving average, but it's still well above the 200. The 50-day is still flaring out at this stage, and it's probably got a couple more weeks with the price underneath it before that would turn down. So that's all mild stuff. You certainly don't want to be responding to that sort of action. The Nasdaq looks very similar, as you would expect. Now let's just look at the Russell index as well, because markets do tend to top out when the small caps start falling, and the Nasdaq is within an absolute whisker of its all-time highs. So all the bearish commentary out there, my advice is pretty much just ignore it. Let's look at the VIX index. So you can see we did have a blip in the VIX index on Thursday and again on Friday, but both times the index settled right back down again around 10. So there is really just no sustained concern in the market at all at this point in time. While we're here, let's look at currencies. The US dollar broke down through the week, and particularly Tuesday, Wednesday, Thursday, you can see moved quite sharply down. That was partly because the euro is actually strengthening, so that was part of the reason. But we also saw commodity currencies pick up as well, particularly at the end of the week when oil bounced, copper bounced back up again, and so did iron ore. So if we look at the Australian, let me just find it. There we go. We look at the Australian dollar. We did move back up close to 77. So we're back up to the top of this range now. We're back up in the second part of this two-layered range that's been in force now since around about January, so pretty much all year. But look, my firm conviction remains that the Australian dollar over time is headed lower for all sorts of fundamental reasons. It's pretty hard to fathom why it's back up at 77 at the moment, but I'm by no means a currency expert. So nothing surprises there, but the possibility over the next few years of the Australian dollar moving down below 70, and if things turn out badly, which I think given our political leadership in Australia and decision making is quite possible, then I wouldn't write off a sub 60 Australian dollar. So not a good outlook for the Australian economy at this point in time. Just while I'm here, let's just look at the ASX 200, and you can see that it's really done very, very little. We broke above the 5,600 level on the 20th of December, and we've moved up to about 59.60, and it just can't get beyond that at this point in time. So you can see it's been, the last time we were above that was just before the GFC, and here we are a decade later, and we're still lower than our GFC peak. So it's been a pretty brutal time for Australian investors. So that's just summarising. The dollar up almost to 77, and the ASX index managed to gain 6 points. But the good gains that we saw earlier in the week were all given back on Friday in a pretty disappointing session. And there's really no sign that our index, or really the banks, which are the main driver of our index, are going anywhere. Moving on now to precious metals. Gold was down by $16 to $12.42, so still looking weak. Interestingly, though, the main global ETF, GLD, remains steady at 852. So whilst we're seeing gold go down and some selling in the speculative futures market, the ETF market, which is investors, which is required to sustain a bull market in gold, has held quite steady at 852. Precious metal stocks were down marginally, but they're still within the overall wedge pattern. So we haven't seen a breakdown there yet. But my expectations for the sector are pretty low in the short term. Now, from a seasonality point of view, and you should never place seasonality with a high priority, I think there is some validity to it, particularly with precious metals, because of the buying cycles around income flows to do with crop production, and also cultural reasons as well. There definitely is seasonality in the precious metals market, but I wouldn't hang the hat just on seasonality. But for the record, August is the start of a better period seasonally, so it's quite possible that we'll see a bit more sideways for precious metals until we get into perhaps a friendlier time of year. So let's just check in on precious metals. First of all, silver. So we're still bouncing around, but in a increasingly smaller range. This is gold on a weekly basis. So this declining trend line that we've seen since 2011 picked up peaks in 2012 and then again in 2016, and again has repelled the price down. But again, you can see the fluctuations are getting smaller and smaller. And just zeroing in on a daily basis, I've left this chart, the notations on the chart, unchanged from before the Fed made their decision, and you can see that we did decline pretty close to that trend line, and we haven't bounced yet, as we did here, and then here, and also here, although that wasn't around a Fed decision. We haven't had the bounce yet, but let's see how things work out. Turning to GDX, you can see it's still within that overall wedge pattern, which has got a little bit of an upward bias to it. But as I said, I'm not sort of filled with confidence with that sector at the moment. Commodities, copper rose further to 268, so finally copper responding to the weaker US dollar, and also a bit of improvement on fundamentals. Crude oil got whacked, got down to 42, but then spiked up to 46.1, quite a sharp spike on Friday. So we've now fulfilled that target of 42 to 46 that I've been showing now for about 2 months. That may be complete, but look, I don't trust it. I really don't. If you just look at the fundamentals, whenever oil gets up around the 48 to 50 mark, then that will automatically see a lot of production, particularly in the US, come back on stream, and that's going to put a cap on the price. So it's pretty hard to see how the price is really going to get very much higher than $50 or maybe $60 at the most. I think if you're thinking oil higher than that, you're probably deluding yourself as to the supply and demand situation. And supporting that, I would have expected, given the sharp spike in oil on Friday night, that stocks would have responded more generously than they did. The response from stocks was pretty mild. There's the spot copper chart, so you can see a significant lift in the last week and a half. So just to wrap it up, we've got several global indices at all-time highs. So for me, the message is clear. Markets are not topping. End of story. And we stay with what is until it ceases to be. How to play the next few months? No change. Buy the dips in established strong uptrends, but particularly with technology, don't jump too soon. ABC patterns are more than likely. Now, what I mean by ABC is A is the first leg down, then we get a little bit of a bounce in the B leg to a lower high, and then we get another leg down. Now, so many times in the last few years, all we've had is one move down and then straight back up again. And we haven't had an ABC pattern play out. But the index for technology, so let's just look at that index. So here's our A leg down to here. Here's our B leg, and this is our C leg playing out. Don't expect it to go very far. Perhaps, let's just put a bit of a rectangle on this and see how we go. Perhaps down into this area here, but I think that's about as far as it may go. The run has been so significant that I'm a bit doubtful that we're going to see technology just bounce straight back and form new all-time highs. I think there's a good chance that we'll see 3 to 6 months of sideways bouncing around to let everything else catch up. And that in itself would be a sign of strength. So I think that's the most likely outcome for technology. A little bit more down, and then 3 to 6 months of essentially a range. And that range could be between 54 and let's say 58 to 60 on the index. So I think that's the overwhelming likelihood of how it's going to play out. Now I'm just going to repeat the slide that I closed with last week because I just think it's such an important reminder. So I was talking about in response to the questions that I get constantly, and that's wouldn't it be a better idea to wait for the market to sell off and then we'll jump in? The only problem with that is that there's been a lot of people been doing that for 8 years or more, and they've missed out on the most sensational gains. So this is the slide that I finished with. Think first about risk. We can't know whether the market is going to sell off. It might be another year before the market sells off, and you could miss out on a tremendous amount of move to the upside, because bull markets finish generally with a real acceleration to the upside, and that acceleration can last a year or more. So you don't want to miss out on that. So to me, come back to, well, how do I manage the risk? How can I be in the market and benefit from that upside if it occurs? And that's certainly where the overwhelming odds are at the moment, but still protect myself. So just look at things that you can do to minimize risk and still leave the door open to upside. I refer to them regularly in this video, but just get on with it. Have a clear game plan and get on with it. The S&P index has risen 218% since 2011, while a lot of investors waited for a better time, and that better time hasn't come in 6 years, and they've missed out on more than doubling their money. So waiting for the next big correction might seem like a good idea, and I understand it. It's appealing. It's just not a good idea. So that's it for this week. There's my contact details for non-members who may wish to communicate with me, and I will be back with you next week. Cheers.